If you have $20,000 or more in investments, the advice that got you here is now actively working against you. And every day you follow beginner strategies, you're leaving thousands of dollars on the table. Hey everyone, today we are talking about the critical threshold where traditional financial advice stops working, not just becomes less optimal, but actually starts destroying your wealth building potential. You've saved consistently, avoided debt, maybe maxed out your IRA. You've hit $20,000 in investable assets. That puts you ahead of most people. But here's the truth. The strategies that built your first $20,000 will sabotage your next $80,000. In this video, I'll show you exactly why this happens and the specific strategies you need right now. Let's dive in. The beginner advice trap. At $5,000, the standard advice was perfect. Buy an S&P 500 index fund, set it and forget it, keep fees low. This prevents catastrophic mistakes and builds the habit. But this advice has an expiration date, around $20,000. Why? Because at $5,000, a 3% return difference is $150 per year. Real money, but not life-changing. At $20,000, that same 3% is $600 annually. Over a decade with consistent additions, that differential could mean $15,000 to $25,000 in actual wealth. That's a car, a house down payment, 6 months of expenses. Suddenly, optimization isn't nitpicking, it's essential. The fee structure problem. Let's talk fees and inflation. If you're paying 0.5% in expense ratios on $5,000, that's $25 yearly. Barely noticeable. On $20,000, that's $100 per year. And if you're in managed portfolios with 1 to 1.5% fees, you're bleeding $200 to $300 annually, every year, for investments that statistically underperform. Here's what beginner advice doesn't tell you. At $5,000, you can't access better fee structures. But at $20,000, you suddenly qualify for Admiral shares at Vanguard, premium brokerage tiers, lower fee institutional ETFs. Standard advice doesn't mention upgrading because it's written for the lowest common denominator. The psychological shift. When you had $5,000, treating it like a hobby was healthy. It prevented panic selling and kept you focused on building habits. But $20,000 isn't hobby money. It's serious capital representing months of living expenses, a down payment, emergency funds, or startup capital. Yet most investors continue the hobby mindset, checking monthly, not optimizing taxes, not rebalancing strategically. The mental shift you need. You're no longer a beginner. You're an investor managing serious capital. That requires different strategies and execution. Why 100% S&P 500 limits your potential? The S&P 500 is incredible, 10% average annual returns. But that average hides wildly different sector returns. Warren Buffett recommended the S&P 500 for people who don't want to think about investing. But you're watching a deep dive video, you're willing to learn. That means you can do better than baseline. The 3-layer portfolio strategy. At $20,000 plus, structure your portfolio in 3 layers. Layer 1, Foundation, 50 to 60%. Broad market index funds, S&P 500, total stock market, international. This is your don't screw it up money. Layer 2, Strategic sector tilts, 25 to 35%. Intelligent bets on macro trends backed by analysis. AI and semiconductor growth, clean energy transition, healthcare innovation, cybersecurity demand. Use sector ETFs, not individual stocks. Put 7 to 10% in each of 3 to 4 high conviction sectors. If one collapses, you lose maybe 7%. If one explodes, you capture 2-3x the S&P 500 returns. Layer 3, Opportunistic positions, 10 to 15%. Your smart risk bucket. Thoroughly researched individual stocks, emerging markets, small cap growth. This approach captures higher returns without betting the farm. Tax loss harvesting. Free money. At $5,000, tax loss harvesting saves maybe $50 to $100 yearly. At $20,000 plus, this becomes essential. Example, you bought a tech ETF for $2,000, now worth $1,500, a $500 loss. Your S&P 500 holdings are up $3,000. Sell the losing tech ETF to claim the $500 loss. Your net gains drop from $3,000 to $2,500. At 15% capital gains rate, you just saved $75 in taxes. Immediately buy a different tech ETF tracking a similar index to maintain exposure and avoid the wash sale rule. At $20,000, harvesting $2,000 to $3,000 in losses annually saves $300 to $450 in taxes. Over 10 years, that's $3,000 to $4,500 staying in your portfolio compounding instead of going to the IRS. Optimize your cash position. Stop holding excessive cash. I see investors with $20,000 invested but $15,000 to $20,000 in savings earning 4.5% interest. The math: $15,000 at 4.5% earns $675 yearly, or $526 after taxes. That same $15,000 in a balanced portfolio at 8% generates $1,200, or $936 after capital gains taxes. The difference? $410 annually in lost wealth. Over 10 years, you've lost $6,000 by keeping too much in cash. Smarter emergency fund structure. Tier 1, $2,000 to $3,000 in checking, immediate access. Tier 2, $5,000 to $8,000 in high-yield savings, 1 to 2 day access. Tier 3, $5,000 to $10,000 in short-term bonds, strategic reserve. Everything else, fully invested in your portfolio. Add REITs for diversification. Real estate investment trusts provide crucial diversification. From 2000 to 2010, when the S&P 500 went nowhere, lost decade, REITs returned 9 to 10% annually. REITs have low correlation with stocks. When stocks drop, REITs don't always follow. Allocate 10 to 15% to diversified REIT funds. They're required to pay 90% of income as dividends, typically yielding 3 to 5% versus the S&P 500's 1.5%. That higher yield adds 15 to 20% to total returns over 20 years. Strategic defense positions. At $20,000, you can't afford to lose 50% in a crash. Build defensive positions. Treasury bonds, 5 to 10% move inversely to stocks during panics. Consumer staples and utilities, 5 to 10% companies selling necessities don't crash as hard. Gold commodities, 3 to 5% holds value when everything else falls. These 15 to 25% defensive positions underperform in bull markets but protect during crashes. You lose less overall, maybe minus 20% instead of minus 35%, have capital to buy dips, and avoid panic selling. Studies show this balanced approach delivers returns within 1 to 2% of all growth portfolios over full market cycles, but with dramatically lower volatility, meaning you're less likely to panic sell and actually capture the returns. Your 8-week action plan. Week 1. Audit. List every investment, fund name, ticker, amount, expense ratio, dividend yield, asset class. Most investors are shocked by what they actually own. Week 2. Design target allocation. Example: aggressive growth allocation, 45% broad market index, 15% international, 15% strategic sectors, 2 to 3 funds, 12% REITs, 8% small cap growth, 5% bonds. Weeks 3 to 8. Execute transition. Don't sell everything at once, tax nightmare. Instead, harvest losses first, sell positions with minimal gains next, hold large unrealized gains longer, direct new contributions to underweight positions. Spread over 4 to 8 weeks to dollar cost average into new positions. Week 8. Automate. Enable dividend reinvestment, set quarterly rebalancing, schedule tax loss harvesting reviews, set up automatic monthly contributions. The mental shift. Treat your portfolio like a business, not a savings account. Your investments are employees. Are they performing? Your asset allocation is your business strategy. Aligned with opportunities? Fees and taxes are operating expenses. Minimized? When you adopt this mindset, you ask better questions and move from passive hoping to active managing. Build your contribution system. Getting to $50,000, $100,000 requires consistent additions. Automated wealth system. Pay yourself first. Auto transfer to investments the day after payday. Increase ladder. Every raise. Increase investments by 50% of that raise. Windfall protocol. 50% of unexpected money to investments, 30% to goals, 20% guilt-free spending. The math: $20,000 now plus $300 per month at 8% returns. Year 5, $50,000. Year 10, $95,000. Year 20, $260,000. Increase contributions just 5% yearly. Year 20, $315,000. That's an extra $55,000 from modest increases. Conclusion: you've crossed $20,000. You're managing serious capital that deserves serious strategy. Simple index funds and set and forgets serve their purpose. Now it's time to graduate. What we covered: why standard advice fails at this threshold, strategic allocation beyond basic ETFs, REITs, and defensive positioning, your 8-week execution plan. Knowledge without action is worthless. Winners implement. Your action items this week: audit your portfolio, calculate true allocation, design your target allocation, research 2 to 3 sector funds, set up automated contributions. 6 months from now, come back and comment on what's changed. This is the playbook from $20,000 to $100,000 and beyond. Hit like, subscribe, and download the free portfolio audit template in the description. Now go take action. See you in the next one.